More and more insurance agents are lying to you that index universal life is infinite banking, and that's absolutely false. And in fact, doing that could be costing you thousands, if not millions of dollars if you're not careful. And here's why. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You've worked so hard for your money, and you're now ready for that money to start working harder for you today. You want to become work optional, where you have enough passive income coming in from your investments to work because you want to, not because you have to. You work by choice. You are empowered. You have the freedom to do that so that you can do what you love with those you love sooner. But it's not just about getting rich, because it's about living a rich life. Because as you are blessed financially, as you have more resources and means and money to do things, you now have a greater capacity to bless the lives of those around you, creating a massive ripple effect. And that is why I'm here today, to create a ripple effect through your lives. Again, thank you so much for tuning in, for binging, sharing this with others so that more and more people's lives are blessed because of you sharing this episode. So please do so today. If you haven't done so, please subscribe, like this video, share this video, especially if you feel like this could be something that would help them out. We would so appreciate it. All right, so we've been lied to. There's no secret by financial advisors, insurance agents, and things over the years. I bring this up all the time. I call it out. I know that's why many of you guys appreciate it, because I am candid about it, because I was this person. And so I want to talk about IULs, or Index Universal Life, because I'm seeing a big trend. Even when I'm on other people's podcasts, they'll say, oh, you talk about infinite banking? That's like with IULs, right? This is what's fascinating. IULs were never infinite banking. First and foremost, infinite banking is a strategy, not a product. I repeat, infinite banking is a strategy, not a product. Shout out to the Nelson Nash Institute for the Infinite Banking Concept, or IBC. That is what it was meant for. And it was meant for whole life insurance only. Even Nelson Nash said IULs doesn't work. Why? Because he talks about using that constant flow of money. Whole life insurance does that better than IULs for a few different reasons. One, index universal life is basically buy term and invest the difference, right? Yes, there's a death benefit. Yes, there's that tax-free account, that cash value, right? Just like whole life has. But the difference is this, is that one, they have surrender fees, which locks the money away from you. See, understand that you cannot access anything that's not in that surrender value, right? The account value that's there, you can't touch all that account value because there's surrender charges. So if you try to get to that money, you can't. It is meant to be a long-term product, not something you can do short-term right now to create more wealth and more velocity of your money, which is what infinite banking teaches. Two, one big weakness of index universal life, and any universal life for that matter, is because it's by term invested difference, it's a 1-year renewable term. That means your insurance costs go up each and every year. It gets more expensive as time goes on, but whole life starts out a little bit more expensive, but then gets cheaper as time goes on. Little hint here, if you watch later in this video, you'll see how I show you it will actually be cheaper than even index universal life as well. But that's to come. But anyways, that's what it's known for. Whole life is more expensive up front, but then gets cheaper over time. Index universal life, or any universal life for that matter, gets more expensive over time, which creates a big risk. And remember, it's not meant to be liquid short term. It's meant to be this long-term supplemental retirement income. And that's exactly what I want to show you on this little Instagram video that someone had sent me. It's kind of funny because I'm actually connected with this person, so I don't want to badmouth her. I actually admire her for the education that she's putting out. The thing that's interesting is that she actually works with some of the same guys that trained me, right? Some of the guys that started the company that she's a part of also trained me early, like 20 plus years ago when I was a financial advisor. So I get it. Just so you know, I come from a perspective, I actually sold Index Universal Life before it got popular. I was selling it 20 years ago until I realized when I was training some other agents, there were some of these weaknesses with it, right? Also, I realized too that the stock market, especially what Index Universal Life is based off of, usually the S&P 500, doesn't always work. And insurance companies have been changing. They've been changing the benefits of it over time to where it's been a lot of overpromise and underdeliver with the numbers that they've been quoting you when it comes to Index Universal Life. So anyways, I want to show this video because I want to show you, or I'm going to run it all the way through, just straight through so you can see it. And then I'll break it down and then compare about how does it compare to whole life and why again, this, what she's talking about is not infinite banking, even though she's giving it lip service. And the only reason, one of the only reasons they know about infinite banking is as I literally talked to one of their leaders in that company saying, hey, here's what you can do with infinite banking with whole life. But because they don't sell whole life, they decided to twist it and make it for universal life. So I thought that's kind of an interesting full circle thing that I taught one of their leaders about infinite banking, and this is what they came up with.
I met with a young business owner that was looking for an alternative to the 401k. She did not like the 401k because if she needed money, she would have a penalty for accessing that money. So I showed her an indexed universal life insurance policy that would allow her to borrow against her own policy without that penalty. She loved it and decided to start putting $1,000 a month into the policy. So let me show you some of the benefits. The first benefit is that if something happened to her from day one, her family would receive over $600,000 in death benefit. The second benefit is if the business needs money along the way, she can borrow from the cash value of her policy without any kind of penalty. The third benefit is that when she reaches age 65, she will have $1.2 million available to her. So she could turn on an income stream of tax-free money that she cannot outlive. Let's say that at age 65, she decided to take that $1.2 million and turn it into $108,000 of tax-free income that would last her the rest of her life. And when she passed away, whatever is left would go to her beneficiaries tax-free. I believe that the IUL is an amazing retirement strategy for business owners because of the flexibility, the tax-free access, and no penalty for early withdrawals.
Okay, so that's what her thing is. Interesting stuff that she taught there. Some things very true. Some things you got to be careful. Now, it sounds like when you're hearing this, right? It sounds great, doesn't it? It sounds amazing. You're putting in $12,000 a year, $1,000 a month for 30 some odd years. And then you, lo and behold, you're pulling out over 100 grand a year tax free. Sounds great. And in the meantime, it's accessible for that business owner to use in the meantime if she ever needs to get to it. That is true. That part is true for sure. But let me break down exactly where there's some fallacies or some assumptions that actually this video could get her in legal trouble. Okay, so let's talk about that. Let's break it down right now.
401k. She did not like the 401k because if she needed money, she would have a penalty for accessing that money. So
Great. Good opening. Obviously, yes. The one weakness of 401ks you've heard me say is that it's not liquid. It's not accessible. And that's a big, big problem. You lock it up in prison.
Showed her an indexed universal life insurance policy that would allow her to borrow against her own policy without that penalty. She loved it and decided to start putting $1,000 a month into the policy. So let me show you some of the benefits.
Okay, here we go. Now, here's what I want you to see first and foremost. And I want to kind of talk to you like I'm the person like behind the scenes trying to tell you what's going on, because that's exactly what I'm doing. I'm pulling back the curtain. Notice that she's going to spend most of the time on the right-hand side of this page. I notice also she very cleverly does not show you what rates of return are in this policy. Now, with Index Universal Life, just a little bit above the screen here, it'll even tell you the actual assumptions, which are not guaranteed. They're all based on if the market might do this, here's a rate of return, right? And there's technically actually 3 scenarios, but she's focusing on the third scenario that I'm guessing probably shows about pretty close to a 7% yield, maybe higher. She's actually trying to show here, which, by the way, has not been happening long-term in Index Universal Life. And so this is why I call bull when people look at this. Usually the second scenario is a little bit closer. Somewhere between the second and the third might be more likely. But again, this is one of the problems. So here she's going to explain about the death benefit for a little bit, as well as the cash value.
The first benefit is that if something happened to her from day one, her family would receive over $600,000 in death benefit. The second benefit is if the business needs money along the way, she can borrow from the cash value of her policy.
Okay, so she's talking about you can borrow from that. See, she knows she's pointing at the surrender value. The account value is the money that's in the account, but you can't get to all that money. The surrender value after the surrender charges, because that's something that Index Universal Life and all Universal Life has that you don't see with whole life. The surrender value is what's actually accessible. So here she is actually saying what's correct. She's pointing at the right numbers here. Notice she's putting in 12,000 a year. If we go through 12,000, the first year you have about 7,800. After you have 24,000, you have about 18,000. You put in 36, you got 30. This is not a badly designed IUL. I will say this, it's not horrible. Now, see, by that fifth year, she's put in 60, she got 56. Finally, by the seventh year, she's paid in 84, she's got 86,000. So notice it takes about 7 years to break even at this point. Again, the surrender fees aren't super excessive. I actually think that's pretty cool based on whatever company she's trying to use here. But again, it does take 7 years before you finally have more than what you paid into it. All right, so be aware of this. And she's actually running a female that's age 33 is what I figured here. So a female age 33 is what she had run.
Policy without any kind of penalty. The third benefit is that.
Now pay close attention to this. Now she's showing you age 65. So that 32nd year, pay that 12,000. So she paid 384,000 in. Notice that she's showing at age 66, you're pulling out 108,000 a year. But what is that number based on? Watch this.
When she reaches age 65.
Now I'm pausing here. She goes right past. Remember I mentioned there's like those three separate sections? There's section one. Section one usually assumes you make a 0% return on the money you're putting in. Now, this is not likely, right? This is just saying if the IUL pays its minimum. This usually happens when the market goes down or only goes flat. Not a likely scenario. But notice, if you get the guarantee, the cash surrender value is actually depleting. I have seen this so many times, universal life policies, that as people get into their 60s and 70s, because the insurance costs, remember, the costs go up every year. You get more and more expensive. Because those costs keep going up, it's actually draining the account, which is exactly the time they teach you to take this retirement income. So the increasing costs are draining the account and you're trying to pull out retirement at the same time. It causes the money to disappear faster. But of course, they always show you the far right, which has the higher return. Now watch this. We'll go to the second one. Oh, just so you know, just so you're aware, that first year, you pretty much ran out of money if you try to pull out $100,000. That's why it's zero. Your policy lapsed. It canceled. The second section, notice here, now there's a little bit more of that surrender value, right? It got up to 761,000. But of course, after you stop putting in, you start pulling it out, bam, bam, bam. You know, it lasts for about, and by the way, the middle range, usually it's like a 3 or 4% is usually what they'll show you. So if it only earns an average of 3 or 4% a year, again, not as likely, but it's possible. You're likely to get a little bit more than this. But notice that the costs are eaten away. And when you're pulling money out, it did not last very long. It lasted really 1, 2, 3, 4, 5, 6, 7, about 8 years. And then you're out of money. But she skips right past that, doesn't she? She doesn't want you to see that one because it says, oh, look, you just ran out of money. You're broke. I'm trying to pull out 100,000 a year. She goes to right there. Now she says she will have this right here. Her saying you will have is not legal. There is no guarantee. This is a non-guaranteed illustration, which again, at the very top there, right above where it says account value, surrender value, she's got it right above the screen. So you can't see what kind of returns they're projecting, they're guessing, literally not guaranteed. This is even true with whole life. Whole life is not guaranteed either, although the values stay much more stable and they're much more predictable than anything with stock market, right? As we well know. So she's saying she will have $1.2 million. Will she? Will she really? Because that last example was closer to $600,000 or $700,000. That's like half.
$2 million available to her. So she could turn on an income stream of tax-free money that she cannot outlive.
She can't? She cannot outlive? Are you sure about that? That again is a very bold claim that someone, if they saw that and took her for her word, would say, hey, I was promised I would never outlive my money, and guess what? The market didn't do what we expected, and I outlived my money. That is dangerous right there.
Let's say that at age 65, she decided to take that $1.2 million and turn it into $108,000 of tax-free income that would last her the rest of her life.
She actually stopped, she stopped about 25 years down and didn't show you the bottom. Did it last the rest of her life? And how long does she live? Do we know? That's the real question. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now.
And when she passed away, whatever is left would go to her beneficiaries tax-free. I believe that.
Yeah, whatever's left. Now, this is the biggest thing I see with IULs. Everything's about speculation. No one knows, right? And even when I sold IULs, I'll tell you, IULs were better 20 years ago than they are today. So understand with Index Universal Life, they have a floor, right? A floor, usually a guarantee of 0 or 1% that you should not earn less than on the interest. This is why they'll say it's quote unquote guaranteed, but doesn't not mean that it's not guaranteed to not lose money. It may not have a negative interest rate, but say you earn 0%, still insurance costs come out. There's still expenses coming out that cost you money. By the way, when you put in, there's a lot of additional expenses and things that go into this as well. So there's a floor of like 0 or 1%. The ceiling, right? The cap, the most you can ever earn, and that can change year to year based on what the insurance company says, is right now, for the most part, it's between like maybe 7 to 9%. Sometimes you might see a 10% cap, as they call it. This means that the stock market does 20%, like the S&P 500 does 20%, you get that 7%, 8%, 9%, maybe 10% if you're lucky. Did you know that when I used to offer these 20 years ago, you know what the cap rates looked like then? 10 was the low number. It was 10 was the low cap. Some of them were 12. There was one company I worked with, which was Fidelity and Guarantee. They were at a 17% cap. 17%. So of course, when we illustrated, we would illustrate 7 or 8%. Since then, especially after like 2007, 2008, and so on, they slowly started bringing those cap rates down. That's why right now, I think the average cap rate is somewhere between about 7.5% and 8%. It's not very high. That means if the market does 30%, you still only get 7.5 or 8. Now, if the market does negative 20, you still get 0, maybe 1, but that's it. And there were some, by the way, we had floors of like 2% back then. So we had floors of maybe 1 or 2% with a 12%, 10%, or a 17% cap, right? So that means you would get higher returns because if the market does 5, then you get 5, right? That's pretty simple. It's when it goes above, especially when it gets higher, you lose out on all those extra gains in the market. Now, of course, you don't get any of the losses, which is good, right? It is safer in that sense. But the problem is they still project out these returns that really are not guaranteed. And so when they show you that far right-hand side, I call bull because the truth is in the last 20 years or so, even though we've had a great stock market run, most of these plans, because they've adjusted the cap, even after people got in, they lowered the cap on people, the projected returns are less than what they were hoping for. That is what you got to be aware of. Now, with whole life, can interest rates go up or down? Yeah, they can. One particular company, like the one I'm going to show you here, they've only paid between 5.75 and 6.34 for the last almost 20 years. So think about this. The range is only like maybe 0.6% spread in the last 20 years. That's all of it. During the Great Recession, the global financial crisis, even with 2020 and everything else, they stayed consistent. They stayed steady. It went down to 5.75 only because interest rates went rock bottom after 2020. And that was after they were rock bottom. So with all these rock bottom interest rates, that's what you get. So just so you know, whole life's more based on like treasury rates, current interest rates and things like that. So as you see rates go up, if the Feds are talking about keeping rates higher for longer, this is good for us. This is why we're seeing now 6% or more with life insurance companies. So let me show you just the same kind of example on my end. All right. So here's an example right here. 12,000 a year, starting her at age 33. It says 34, but that's when they turn the next year, right? Notice, remember hers was 7,800, mine's 9,800 from day one. So already I'm saving them $2,000 and there's no surrender fees. It's just insurance costs that came out, no surrender. In fact, this almost matches what she was showing in the first year on the non-guaranteed side with the highest interest rate. This was almost the same exact number as before you factored in the surrender cost, but 2,000 more than what she showed you there, right? So 9,800, almost 9,900 at that point. Year two, we got 20,000. Three, 32,000. Now remember, I said it took till year eight where she had about $86,000, I believe it was, right? After paying 84. Well, guess what? Or sorry, year seven that was. So I paid 84,000 here, but look, instead of 86, I've got 91,000. This is even with most likely illustrating a lower interest rate, just showing 6%. That's all this is showing is 6%. So notice that by year five, put in 60,000, you've got over $60,000. This wasn't maximized completely. I was just trying to match her, numbers, apples to apples. That's the one thing that if you're wondering, like, how do I know if I get good numbers or not? Make sure somebody matches them apples to apples. Now, if I were to talk to somebody like you, for example, and you were looking at an example like this, I would say, this is the apples to apples example. We still beat it. Even those first early years, it gives you access to more cash anyways, and with more guarantees. However, here's the great thing is that I can actually do some tweaks on here because this gave you a higher death benefit than even she was showing. And so we could actually do some tweaks to make it a little bit more juicy in the sense that we can lower the death benefit, increase the ROI a little bit on these numbers here. So, but anyways, I wanted to stay apples to apples in this case. Now, notice too that as time goes on, right, just like she had. Now, when we get to age 65, just like she was showing, now we've got 975,000. We got just shy of $1 million. Now hers said 1.2 million on that far non-guaranteed side. Remember the one that was midpoint was right around like 600, 700,000, right? So like I said, it's possible, depending on the returns they get, it's possible they could get pretty close to what we get, maybe even slightly beat it, but not likely, or not much more if they do beat it. And again, with all the uncertainties, remember the market doesn't go straight up. This is the problem with IULs. They show it just a common steady return like its whole life, but it's not. It's not whole life. It's not steady. It can go up or down. Like I said, you get a couple bad years in the market. If you only get 0%, unless you're putting money into it, it's not growing because costs are coming out of it, right? Insurance costs are coming out. You don't have that problem with whole life. Whole life guarantee, by the way, is usually around 3% or so. That's if you don't get paid a dividend, you still get 3%. The company I'm showing you right here has paid a dividend. They paid higher than their minimum since the year of 1847. So almost 180 years straight, they've paid more than their minimum guarantee. Is it guaranteed? Obviously, no. It's still considered a non-guaranteed illustration, right? It could be higher, it could be lower, just depending on what the interest rates do in the future, right? Now, I'll tell you this, income stream wise, would you be able to pull out that for the rest of your life? Probably not. When I ran the numbers, it's like between 60 and 70,000 based on what she was showing there too. If I were to try to only show 25 years coming out, you could probably pull out about 60,000 or so a year, tax free, because again, I never want to overpromise anything. I want to make sure that you have it. And look, yes, you do have a nice little death benefit, that of course you can be accessing and using as well. So that's the thing. It's like I can do the same thing, if not better, with less risk. And most importantly, coming back to infinite banking, right? Is with infinite banking, it's about how can you use the cash now, right? What can you do right now? Now, am I going to use this to go get a car loan? No. This is another thing too. Most index universal life policies, you do not earn income when you borrow from it. Now, they will credit you in just enough interest to make sure you have a wash loan, as they call it, so you don't have any net interest that you owe. They'll do that, but you're not compounding interest on the money that's in there. Whole life, say I have $1 million in there and I borrow 300,000. Well, guess what? All million is still earning that dividend. It's still earning those tax-free compounding interest. Yes, I'm paying interest to the insurance company, right? I can do that as well, but I actually want to pay interest to the insurance company because it allows all my money to grow and compound, where I can use that money to create more for cash flowing investments, using that cash flow to pay down that interest, creating a simple interest situation while I'm earning compounding interest. I can actually out earn the interest that I'm being charged by the insurance company significantly more than if I had an IUL where they just say, great, we'll give you like a 0% net loan, if they even offer that. Most will after so many years, but many won't. And many will still charge you a little bit of interest on that loan. And so again, just different ways of using it, which is why with infinite banking, when they talk about borrowing from the insurance company, borrowing from the policy, it uses better. Also with banks, there are some certain banks that will loan you money based on the cash value with your life insurance policy. I've even had them on my show years ago before. Not as much lately because the interest rates have gone up for them, the Fed rate. But as the Fed rates, if it does decide to come down, probably will end up talking about that again more often, where you could possibly get a lower rate than what you're paying, getting paid in dividends. Right now, they're about the same. Anyways, the reason I bring that up is because there are banks that will lend you from a whole life policy up to 95%. But when it comes to universal life policies, banks, if they actually lend on it, which many banks refuse to lend on these policies because they're not guaranteed because they can lose money, especially with the increasing cost, they might only lend up to like 65% or something like that. So you have less leverage anyways. So I know that all the stuff out there, they're trying to pitch you because it seems sexy, right? You can get those market returns, but not really. But you can kind of like get something that's like the stock market without the risk of downfall. That's true to a degree. But the problem is you still can't use that money to create acceleration. And I personally like to use my money to make more. Lately, I'm not really using my policy a whole ton right now because I'm using it as cash reserves to store and keep safe for emergencies and for opportunities, as I really do believe that there's still a bigger bubble to pop right now. The government has been delaying this bubble. It's almost like that bubble. Have you ever blown a bubble? For those of us that lived in the 80s and 90s, we know what this is like. You blow a bubble and then it just kind of sits there. It doesn't really pop yet. It's just kind of sitting there. But if you were just to add a little bit more pressure to it, a little bit more air, or just go boop, like that, it goes all over your face and gets in your hair, and then you're putting peanut butter in it and all that kind of stuff, right? It's kind of like that. The bubble is really ready to pop, and we have had an everything bubble. This is a great time to have liquid cash on the side available. Still a great time to invest. Still a great time to do that if you're very selective, if you know the right people to put your money with, and you're doing the right kind of investments that are still working right now, as opposed to other investments that aren't. And that's why a lot of our clients are saying, okay, I'm getting tired. I'm getting fatigued just trying to figure out who to invest with and which investments are good. Can you help point me in a better direction? Can you give me some more guidance here? And that's what we often do with our consulting, when we do our work optional blueprint for people. But when it comes to this, when you're using your life insurance, the great thing is it's a great place to store more cash, earn a higher yield in your bank. It's safe. You don't have to worry about market returns going up or down and possibly not making money that year. It's going to be there earning 6% or so tax free, especially right now, right? Even better is that, when you do need it and when it's time to use it, you can actually use it to create more interest, more money, and accelerate your progress towards your freedom goals. So anyways, just be aware the IUL thing is just a product pitch. I'm surprised you haven't seen more people talk about VULs, variable universal life. That's starting to make a comeback finally. And it's at the wrong time. It's at the top of a bubble, the stock market bubble. Worst time to do variable where you get the ups and the downs, meaning you get the losses too. Be aware of those. People are going to try to pitch that as infinite banking too. Infinite banking is the strategy you use with whole life insurance, period. That's what it's used. Don't buy in the IUL crap. Don't believe it. It doesn't mean that it doesn't have a place. Doesn't mean that, by the way, we can do IULs. And on a rare occasion, we do it for people. But it's just right now is the wrong timing, the wrong time of the stock market to go with an IUL. I believe IULs work better after there's been a market crash. Now you have a little bit better chance of success. That's when you might look at that strategy. But right now is like the worst time to do an IUL, but the best time to do whole life because now the rates have been going up while the markets are overbought and potentially could be going down. This could be one of the best and safest places you can safeguard your money, not just from taxes, not just from market losses, but even from lawsuits and creditors too. So anyways, if you ever have questions about that, feel free to reach out to us at moneyripples.com. If you're looking at IUL, send it to us, right? Send it to us and say, hey, here's what I was sent. What do you think? Is it good? Are there some dangers here that I'm not seeing? We're willing to give you an honest opinion. If it's actually good and we think it's good, we'll let you know. It's very few and far between, but on a rare occasion, I've told people, I said, you know what? This might be a plan you already have. You might want to keep it. And there's been other times it's like, you know what? By keeping this, it might cost you literally hundreds of thousands, if not millions of dollars. And that could be your situation as well. So again, we're here because we want to create a ripple effect and we want to make sure that you are protected, that your money is safeguarded, that you know it's going to be there when you and your family need it the most. Let us know if we can ever support you in any way. Have a wonderful and prosperous week. We'll see you later.